however many shares you want to buy, let's say 1, review the order, swipe up to submit at the bottom, swipe, just like you'd be swiping for Tinder, order received, hit done, and you're done. Hello everyone, Leon Shin here, where my mission is to increase the wealth, health, and happiness of all my viewers. What if I were to tell you there was a ridiculously easy way to invest in the stock market that required no experience at all, virtually no time commitment, work in any sort of environment, whether the stock market is going up or down, there's pretty much guaranteed profit, will outperform the majority of the funds out there. You can be working at any sort of job. You would think I'm out of my mind, right? Well, I will tell you the secrets. All I ask in return is that if you find this information useful, to like, comment below. If you're interested in this kind of material, to subscribe, and also share this with all your friends too. I also have to tell you, due to legal reasons, although I am an MBA, I'm not a licensed financial advisor, and I can't legally give you advice. You do have to do your due diligence, but I do recommend, if this is interesting to you, do a little bit more reading and see if it's right for you. This is in 6 easy steps. Step 1, have a reliable income. Just a monthly income. It doesn't have to be a lot, but you do need to have some sort of income, whether it's a job or some sort of money that's coming in. Step 2, minimize your expenses. If you live on your own, this is essentially just basic stuff like rent, utilities, food. If you live with your parents, you can minimize the majority of your expenses. It's pretty much just going to be a cell phone probably. Step 3, subtract the expenses from the income that you have and take a portion of that money and dedicate it towards investing. Make sure that this money is not something that you're going to need for the next 2 or 3 years. Make sure you have an emergency fund set up first, and then this investment money is separate. It's very important that we emphasize this. Step 4, open a stockbroker account and put the money into it. You can use Charles Schwab, you can use Ally Finance, you can use E-Trade. The one I personally use that I think is very easy to use from your phone is probably Robinhood. There might be others out there, but that's the one that I like to use. Okay, I'm going to show you how to get the Robinhood app. Go to the App Store, type in Robinhood. Go ahead and download. Once it finishes downloading, you just click on the Robinhood icon. Now keep in mind, mine is already set up. But for you, you might have to put in all your information, sign up, and all that. But once it's set up, it'll essentially look like this. Look at this magnifying glass at the very bottom. Type in whatever stock you want to get. There's this thing on the top right that says market order. If you click on that, you have different options. I don't want to complicate this. I will explain later what this is, but for now, just go with market order. However many shares you want to buy, let's say 1, review the order, swipe up to submit at the bottom, swipe, just like you'd be swiping for Tinder, order received, and right now the market's closed when I'm filming this, but if it was open, it would execute, and then you would be the owner of 1 share. Hit done, and you're done. Step 5, buy a Standard & Poor index fund. I'd like to tell you the exact one, but due to legal reasons, I can't tell you the exact one, but you can definitely Google and type S&P 500 index fund. There's a number of them that are good out there. Step 6, repeat all the steps we just talked about every month. That's it. There's actually a step 7, and that's enjoy your profits and your dividends. Is it really that easy? The answer is yes. Warren Buffett, who's known as one of the richest men in the world, and he also is known as probably the best businessman in the world, actually made a bet with a fund manager. He actually made a public bet. He made a bet to everyone, and it happened to be a fund manager that took him up on this. But he essentially said, I bet $1 million that you can't beat this method. And one hedge fund manager actually took him up on that offer in 2008. 10 years later, when they wanted to see who won the bet, Warren Buffett won, and the hedge fund manager conceded defeat. So let's put this into a real world scenario. Let's say you were to start using this method by the time you were age 18 to 60, the age that most people retire, and you deposited 100 per month every month until the time you were 60. Let's use 7% interest rate. That's about the average. Using this method, you probably go a little bit better, but let's go on the lower side and just give you kind of a minimum estimate. How much do you think your money would be worth at age 60? $296,131.80. Now, this is making an assumption that you only put in 100 per month every month. However, if we were to make the assumption that most people advance in their career and they actually make more money, then they have more money to put into their bank account, this would just be a minimum amount. So let's look at scenario 2. And this is probably more important for those of you who have kids or are planning on having kids. Let's say from the time they're born to the time that they're 60. Again, we do the same thing. And how much do you think that they would have by the time that they're 60? Quite a bit, huh? Now let's look at scenario 3. Let's say that you decided, I'm not going to do this until I'm a little bit older. Say I'm 30, okay? Same thing. It'd be worth $121,287.65. It's less than half of what it would be if you had started from the time you were 18. This is why it's important that the sooner you start, the more money your money can work for you rather than you working for your money. Let's look at what happened if you use this method in an up market, meaning the market goes up. Say you started this process at 2003 and then you were to check it at 2007. Of course, I do recommend that this is something that you do long term. So when I talk about long term, I'm talking about 5 years or longer. However, for the purpose of this demonstration, we'll just use what we got here. You'll invest at the beginning of every month. So 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. And then say you keep doing this process again in 2004, 2005, and again, 2006, and then keep doing it again. Well, however much money you put throughout all these tick marks, it's gone up higher, at least the highest it's been, and you are happy because your investment has gained money. Now let's look at what happens if you do this in a down market, meaning the market went down. So you started at 2004, and then you stopped at 2010. However many amount this is to be every month, you stuck with your discipline. You just keep going, keep going, keep going. Uh-oh, stock market's starting to go down, but you stick with your discipline. Now you look over here and you look at the price, still a little higher, but you just didn't make as much money. However, let's see what happened. And you continued, continue, 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 continue. Now you're over here. Well, what just happened? If you look at this whole area right here, you just bought everything at a discount. Just like if the store had a sale and you bought everything for cheap. Don't they say in stocks to buy low and sell high? However, I wouldn't encourage you to sell here. I'd encourage you to hang on to it. This is your nest egg, so you're going to keep hanging on to it. This method is called dollar cost averaging. So in a down market, you actually ended up even happier because you got a discount on that. Thinking, well, that's great and all, but you're making the assumption that the S&P goes up. Well, let me show you what the S&P has done from 1870 to 2020. If you were to panic over here, would you have missed out when it got up to here, or even when it got up to here? Of course you're right. No one can guarantee that the stock market's going to continue to go up. But I'll let you look at this chart for yourself, and you can kind of decide what you think about that. If it's that easy, why don't more people do this? Well, the first reason is due to commission. If you think about it, where do we get most of our financial information? Generally from people who probably have some sort of incentive to make money off of us, or what we would call a commission. If somebody can't make money, why would they bother teaching you? I mean, think about it. If you could do this yourself, then why would anyone want to teach you how to do something that would make them less money? Our normal education system doesn't talk about financial literacy. Also due to psychological reasons. Really, doing all the steps we talked about is super simple. The hardest part is controlling your emotions. And believe it or not, most people just can't do that. So when the stock market goes down, everyone just sells everything. But if you just stick with it, continue doing the technique that we talked about, you will make money. And then majority of the people who learn to invest, let's face it, people who want to call themselves investors want to think of them as someone who's more financially savvy. And they think that they can do better than this method, such as that same fund manager that took that bet against Warren Buffett. I do need to caution you though, there are a few things that you need to know before you do this. First, you must not need this for emergencies. I know we talked about this, but I can't reiterate this enough. You must have an emergency fund and this investing fund, which is separate, that you can't dip into. This method will work as long as you can meet that requirement. Two, if you want to maximize results, you have to continue to put money in even when the market is down. I know that sounds really simple when the stock market's doing really well, but when it's actually going down and you have to do this, it's incredibly difficult. Third, when the stock market goes down, you're going to really want to sell. But what I have to say to you is 4 letters. If you don't know what that means, Google it, you'll find out. There's a saying in the investing world, discipline trumps conviction. And what that means is that sometimes emotionally, you're going to feel really like you need to sell, but your discipline will prevent you from doing so. Emotionally, you'll want to sell, your discipline will trump that and tell you, do not sell. Keep with your discipline, keep putting the money in the steps. 4, the psychological part is actually the hardest. In fact, you might be better off to not even look at the number every day. I know you're going to want to because it's fun. You look at it and when it turns green, you're going to have a big smile on your face. When you look at it and it turns red, you're going to have a big frown on your face. It's better to just not look at it, put the money in every month, and let it go. 5, you're going to encounter people that you just talk to every day. They're going to be bragging about how they made so much money in Bitcoin or in Tesla or in Apple. It went up 300% in one day. But they're not going to tell you when the next day it drops 400%. So all you got to do is smile and say, cool story, bro. Thanks for watching this video. If you thought this information was helpful, hit the like button below. If you want to see more of this, hit the subscribe button. Comment below if you have any thoughts, questions, or your personal experiences. Share this with all your friends. Don't be greedy. Don't be selfish. Everyone can benefit from this information. Thanks, and I'll see you next time.